Nice to have you with us here on the Open. So the U.S. futures pointing to a potentially negative start today. We've already talked a little bit about the stage being set for more interest rate hikes in the U.S. by the U.S. Federal Reserve Chair yesterday. We're also continuing to digest a lot of earnings stories, and the picture right now somewhat mixed on that front. Let's check in with Michael Rourke, Chief Market Strategist, JonesTrading, for a little bit more on the mood these days. Mike, always nice to see you. And I would like to start with how you interpreted the many comments from Jay Powell yesterday.
I think the key takeaway from what Chairman Powell said was that if we continue to see strong inflation and labor data, that the Fed may need to tighten more than is currently in the forecast. That happened last year, and obviously with the trends we're seeing with the data right now, while inflation's decelerating, it's still very strong.
And that is a theme you were watching very closely when it comes to the fact that we already saw a somewhat resilient market, a really strong start to the year. Is it your belief that we're going to be having a fresh conversation as we roll through this year, not about rates going down, but the real challenges in bringing inflation down?
Yeah, I mean, the problem is core inflation. It remains sticky. It's been resilient in its own right, and it's coming down very slowly. Core CPI, core PCA are more than double what the Fed funds target is. So that's what we need to come down. It's like I said, it's coming down, but just very slow. And one of Chairman Powell's key points is he needs to, the area that is resilient has to do with services where labor is the biggest input there. So that's why he thinks we need to see job losses or, unemployment to rise in order to get inflation to start to come back down. And obviously we had a blowout jobs report in January.
Yeah, no doubt. And that was an eye-popper and a complicated story. And we've got our own jobs report to watch for in Canada a little bit later this week. I do want to talk about corporate stories, too, though, because, I guess you can slice and dice earnings season a number of ways. But you've made a really interesting point tied to all this excitement around AI. The idea that in the face of a lot of uncertainty, stories are finding their place in the market.
Yeah, Chairman Powell's made the point frequently last year about financial conditions being easy. And it's something that former New York Fed President Dudley talked about, that financial conditions need to tighten for the Fed's policy to work its way through the system. We haven't had, haven't had a meaningful tightening of financial conditions. So you still have this speculative money out there. And what's happened is with the economy, while the economy's fine, but we know policy is not in a great place. That policy is a headwind for the markets, and earnings haven't been great. People are looking elsewhere. So of course, AI, when ChatGPT came out, it came out. It crystallized in the minds of everyone. Wow, this is incredible technology. So anybody who mentions AI, their stock gets an immediate pop. And yesterday was the prime example of it. Baidu confirmed news that was out more than a week ago, and its shares rallied sharply. You had Microsoft and Google talking about how they're going to integrate AI into their searches. They're both their stocks went up sharply, but again, they compete with each other for search. So everyone's not a winner here, and it's such early days that, again, it's just people, the market embracing certain themes, hoping that they're the next big thing. But right now, they're just speculative stories.
Which speaks to your earlier point of maybe the financial conditions picture, not quite what central banks need if they're going to be successful in their fight. Against that backdrop, Mike, what are you recommending to clients right now if they want to be invested in equities?
Well, I think I talk about it every time I come on here, that I like the financial sector. I think the financial sector is just, the banks are run very well these days. Just post financial crisis, I think they've done a great job. So that's the one area of the U.S. equity market I like. Otherwise, I would be defensive. I'd look to more defensive sectors. I think the rally we've had in the last four months or so in the U.S. is probably a bit much because, when I talk about those financial conditions, in 2022, the Fed funds rate averaged 1.8%. In 2023, it's going to average 5%. And that's the environment investors should be, investing for and positioning for. Instead, we're still, making these speculative bets, based on last year's data and last year's level of interest rates. And I think going forward, like now that you had this nice rally here, you should take advantage of it, be a little more defensive. And I think you'll get much better opportunities to buy stocks later in the year.
Let's also just talk about energy, because obviously it's one of the most influential parts of the Canadian stock market. And unlike AI stocks, generally we have seen oil trending lower. It's up today, but this is a really complicated one, Mike, because when we talk about the economic outlook, it doesn't seem great. It's hard to make a strong case around huge demand for oil. And yet, when you start looking at the pieces of the oil equation and the producers and the possibility of China's reopening, fueling demand, there's a lot to think about over the next few months. So how are you approaching energy as an investment?
So a year ago, I loved energy. I thought it was in a great place. I did get concerned in the second half of 2022 about, recession fears would obviously be a headwind to energy. Well, here we are in 2023. Most of those recession fears have at least abated for the time being. Maybe they reemerge later this year. So that's a positive for energy. Obviously, China's reopening is a positive for energy. The flip side, the negatives have been obviously the big premium that occurred with Russia's invasion of Ukraine has come out of it. And then we've had this remarkably warm winter, at least here in the Northeast United States. So those are the opposing forces. But I would say my outlook for energy at this point in time is much better than it was, 3 or 4 months ago, where I was more concerned about the U.S. dipping into a recession, first half of this year. I do think the U.S. is going to slow down, but I think it's going to be pushed into the second half of the year.
Okay.